Welcome to our webinar today. If you paid attention to our webinars in the past, you know we like to talk about people having a niche. We're going to drill in on one of our niches today that we're developing with our expert in here, and I'll introduce Dan here in just a second. I'm going to facilitate today's session. My name is Tom Waddleton. I am a virtual CFO with Summit Virtual CFO by Anders. So my role, I work more with digital agencies than I do in this particular niche, but it's consulting with companies and acting in the capacity of their CFO. So I mentioned Anders, I also mentioned Summit. So let me just tell you a little bit about our company. Dan, if you'll jump onto this next slide. We started as a traditional accounting firm a little bit more than 20 years ago. Audit, tax kind of work that we were doing. In 2004, we started offering CFO and back office services to our clients. Between then and 2013, we really doubled down and said, okay, that is going to be our main service offering, is this virtual CFO solution that we offer to clients. In 2013, we became a fully distributed firm, no longer had an office, lots of flexibility of where our employees are located, also where our clients are located across the US and then some outside the US. And then we were excited last year to announce that we had joined Anders CPA and Advisors. Anders is a more traditional accounting firm with an office based in St. Louis. We've joined them, and now we're the Summit Virtual CFO by Anders division within that. And so now we have this hybrid of remote work and hybrid work. Okay. So as we go on, next slide, Dan Rutherford. Dan is one of my peers as a virtual CFO. Dan focuses on this transportation niche. And Dan, you want to tell just a little bit of a story of how you got into transportation logistics and learned what you know today?
Yeah, thanks, Tom. Appreciate it. Look forward to talking a little bit about transportation logistics and sharing some of my experience. Expert seems to be a kind of a scary word to me. I always heard an expert, someone that came from more than 50 miles away, but I guess I'll take it. I guess I have enough bandwidth to, I guess, fall into that category. But yeah, interesting story, and I think it's kind of speaks to a lot of our clients. A friend of the family, his business was growing, had a successful operation, but was growing, and he had added some additional services and so forth. His wife had handled his accounting and had done an excellent job over the years. I mean, they had done a really good job. She managed cash, managed all the basics, and they were using basic metrics to run their business, which worked well. And he reached out to me one day, and I can distinctly remember the conversation. We're sitting in his favorite restaurant, just chatting, and he was just really frustrated with, getting good, clean financials every month. Some of his customers were requesting financials, and he had big swings because they weren't in accordance with GAAP, and they would clean them up at the end of the year, but he just didn't have good monthly financials. Mm-hmm. His wife wasn't an accountant. So we had that conversation. And then at the same time, he was looking to expand the operation. He was looking at investing, I think it was about $1.5 million in about 100 trailers. And he was looking for some sound advice. Do I lease them? Do I buy them? What do I do? And he had reached out to his local accountant. Wasn't really an analysis he did, but he had a lot of angst. There's a lot of money for him to be popping in, and he really wanted to know definitively what the answer was. So that's what we do, right? As a CFO, we go in and we help someone analyze those decisions. So he and I sat down, I broke that down for him, and we went through all the analysis and everything, mm-hmm. so he could look at it and see have a good solid answer and have confidence in the decision he made. So I've spent the last close to 25 years in the industry working with that gentleman, 2 or 3 other companies. I've run a logistics company or logistics division for one of the large companies. And so I've got 24 years experience in the industry.
That's a cool story. And I guess I'll disagree with you. You start off saying, I don't think I'm really an expert. And then with that story, I'm not sure that someone else qualifies more. I also really appreciate and like that you've done a non-financial role within companies when you ran a logistics company.
Yeah,
it has to really help you when you work with clients to give more understanding of where they're coming from.
Absolutely. It gave me it was a nice break from being an accountant for a while. And
mm-hmm. Sure.
It also gave me a better perspective of the day-to-day operations and how to drive the numbers. I was working with the team on how to not just analyze the numbers, but now I was in the seat to help drive them. So yeah, absolutely gave me some experience and manage those day-to-day operations.
That's great. Well, before we jump into the content, we do have a disclaimer to give, and then we'll leap into topic.
Yeah, it's just real quick. It's just important anytime we're talking to a group of people in an industry, just to make sure we're cognizant of any antitrust conversation, everything regarding vendors, customers, pricing, and so forth. So just be aware if conversation comes up, we need to be aware of that and abide by it.
Sounds good. So one of the things as a firm that we talk about, the approach we take is this profit-focused accounting. And so what we mean by this, and I'll mention these four things in here that are talking about non-financial drivers, clear metrics, a pipeline, and a forecast. And so this is really, as you look at that first bullet, helping a client accomplish their goals. So that's the main thing you're looking at. The reason for non-financial drivers, and Daniel talk about some of this in this niche, is it's the language that they understand, and it's also those controllable variables. And so we do spend time on that, even when we're going through the financial statement, to say, and here's what you have for your non-financial drivers. That really leads to those metrics. And so where you're saying, okay, how do we measure this? You want to grow by a certain percent in terms of dollars, but what are the metrics that help say if you're on track to get there? Pipeline looks to what are upcoming sales. And so how is it that we're analyzing what you've already got as committed revenue in addition to potential revenue coming in? And with our clients, usually we're doing some scenario planning that says what would be like the best scenario, like you win all this kind of work, and what's maybe the worst scenario where you're not winning this work. And then how does your forecast change? And then finding the forecast. If you're trying to help someone meet their goals, we think having a forecast that shows a path to try to get there, and then the constant revisions, because everyone knows if I'm going to lay out a 3-year plan, there's no way that it's going to happen exactly like that. So how do you react when some things are going to be better and some things are going to be worse than that? And how do I adjust the forecast along the way? So that's something we do across all of our niches. And what you're going to talk about, Dan, now are kind of the key metrics that we have as we look at transportation and logistics niche.
Yeah, I think, and like you said, Tom, these apply to all of our niches. They're universal. And it's just, using analogy. I love sports, using analogy of sports. And I was always a Pete Rose fan when I was a kid as a baseball player. And the one thing that Pete Rose always did was, if you watch back at videos of him, he was known for keeping his eye on the ball all the time. The ball went back to the catcher, he'd watch it go to the catcher, back to the pitcher. So I think what these metrics, I kind of consider them the same thing. They're keeping your eye on the ball, right? These are the four main things in any business that a business owner needs to keep their eye on. Keep an eye on their cash, their financial reporting, including their forecasts, their production metrics, breaking something down, a lot of times non-financial, and then their pipeline, actually measuring what's coming in, not just hyperbole and conjecture, but actually having some measurement tools to know what's coming in, so you can adjust your forecast. Do you need to hire people? Do you need to terminate people? So I think these four metrics are the keys to any business, and they're just universal across the board, not unique to transportation. Each one has different KPIs, but I think the overall concepts, would you agree, stay the same?
Oh, definitely. Yeah. And by industry, you might have some different metrics and benchmarks that you're comparing.
Absolutely.
But yeah, if you understand those elements of your business, you're a long way going forward.
Right. So the first one is cash. And I don't think any of us can stress. I mean, it's probably, to me, the most important thing to talk about right out of the gate. When I see you shaking your head, Tom.
Oh yeah.
And we even added here, in trucking, it's literally the fuel in the tank. You run out of cash, literally your trucks can stop running. So if you don't have cash and don't have a plan for it, and as we all know, that's where a lot of businesses start off wrong. They don't have a plan for, they have a great idea, they have a great business model, they just don't have a good plan for identifying where their cash is going to come from, their sources, and how much cash they need. And a good banker friend one time, early in my career, we were talking, and he just very succinctly said to me and reminded me that businesses don't go broke because they lose money, they go broke because they run out of cash. And it was very simple, just very common sense advice, but I always kept it in my back pocket that he was right. It was just that simple, that we as a company could have been showing really good profits, but if we weren't collecting receivables, we weren't turning our cash quickly enough, we weren't going to be able to pay our bills, and we weren't going to be survive. So
Yeah,
good
excellent
advice
point.
from, I think, any banker, just common sense. So how much cash do we need? It's a good question. A recommendation, and there's rules of thumb, doesn't mean you have to start off with this much cash, but I think the minimum should be 10% of a prior 12 months revenue,
Right.
and up to 30%, depending on what the business model is and so forth. And then forecasting for your tax reserve. You always have to be putting money aside, should be doing it every month, so that we don't get caught at the end of the year and have a big tax liability and we don't have the cash set aside. So monitoring both of those is hugely important to
Yeah.
getting your business off the ground.
Yeah, and a comment I would make about that, Dan, often when we work with business owners when we first start, there will be other rules out there like, well, I thought it was 2 months worth of these kinds of payments or things like
Right.
that. What we've often found is the 10% is usually about 2 months worth of expenses. It is
Right.
so much easier for someone to calculate because you get some of these nuances like, well, I don't include the owner's pay in that, or I don't include this kind of expense or that. And what you find is it's a complicated calculation that people end up not doing. This
Right.
10% or 30% you can monitor constantly.
Exactly. Yeah, it's very simple concept, and it's a starting point, right?
Right.
Doesn't mean day one you have to start there. Next slide is just showing an example. If a company is doing $12 million in revenue, trying to build up to 10% of that $12 million in cash and $1.2 million. Again, you're not going to do that overnight, but that should be the target to start getting to. And as high as 30%, depending upon, as we'll speak here in a minute, some of the variables that are relate to their business. It could be as high as 30%.
Yeah.
Some of those variables, and you can probably elaborate better than I even on these, Tom, is when would you need to build up a reserve of 30%? Do you have experience there, or clients that you're like, you guide them in that direction?
I do. Especially if I look at things like down toward the bottom here is the high concentration of one client.
Right.
So client concentration, we often talk about if one customer is larger than 10% of your business. And so you could look at different ones and say, of all your business, you got these three that are making up half of your business. If there's a pullback and they pull back on their sales, you really feel that impact on your business. And if your goal as an owner is to be able to sustain maybe this valley until you can come out of that, cash is what helps you do that.
Mm-hmm.
Otherwise, maybe you're faced with the discussion of getting rid of some really key team members because you can't afford them. And then when business comes back, you're rehiring. That's not something that you want to do. Things like a weak pipeline kind of gets to the same kind of thing. Do you have some adverse things that you see coming up? No recurring revenue means you're constantly hunting and finding that kind of revenue. This is a simple enough list to go through with people because, Dan, as you mentioned, many people don't have this amount of cash. So they're initially like, wow, that seems like such a big number. There's no way I need more than 10%. Let's start going through this and discussing, could these kinds of things happen? And once people buy into that idea, then you can start working toward that number.
Right. Yeah, I've found business owners. I think it's a survival technique. They have some of them have an ability to kind of bury their head in the sand sometimes when it comes to looking at their cash, because it's scary, right? It's scary to really look at it. But the successful ones that I've seen, kind of like the book Good to Great, they face the brutal facts. They're kind of look at the numbers and the what ifs, and they always have a game plan. So looking through some of these like you mentioned, not having a good a pipeline or high accounts receivable days. I know clients that have a 90-day pay on some of their clients and stuff. So some of that can really affect how much cash you need to keep around.
Yeah, great description.
So cash accounts, recommending you're going to have your operating account, right? Pay your bills every day. Cash reserve, which is building up to possibly that 30%. You have the rainy day fund that you should be building up. Your tax reserve, you should be monitoring that, putting money aside every month. so that end of the year, you're not caught with a client's not caught off guard with, oh, wow, I owe $100,000 and you didn't tell me that. Well, we need to be planning for that throughout the year, not just waiting till November and calling the local CPA and saying, how much am I going to owe? And we've all seen that before. We've all seen, and business owners, probably the number one thing that I've observed of business owners, they don't like surprises, right? Because they can't react to it. They can't adjust to it, and then they spend time trying to react to bad news versus managing their operation. And then last, a line of credit. Businesses should be, and we'll allude to that here in a minute, anything you can do to get access to cash is always good advice, in my opinion. The good CFOs are always pushing clients to make sure that they have access to as much cash as they can. It's just critical to have those things lined up, and particularly when you don't need it is the best time to go after it.
Yeah. And the size recommendation you have for line of credit, Dan, what is that?
We'll hit on that second.
Okay.
Most banks are going to go with about 80% of your receivable balance. They will often kick out any receivables that are over 90 days and so forth. But a standard line of credit is 80% of accounts receivable balance, throwing out any of the bad receivables.
Yeah.
So it's really important that before approaching a bank, that client goes through their aging, make sure it's clean. You don't want a bunch of junk on there, stuff from 2 years ago that's not collectible and everything. You want to make sure you're presenting good information to a bank. So when you go in, you're going in with a clean accounts receivable agent.
Yeah. And, we often get the question, do you actually have separate accounts? Because you showed the separate piggy banks, and we would say yes. That some people say this sounds like the envelope system, but picking up dollars and moving to your tax reserve and having them sit there is really smart and doesn't have you fooling yourself by, look at this really big amount operating and somewhere in there is my cash reserve, my tax reserve. That is not what we suggest people do.
Absolutely. It's nice and clean. You can see it.
Right.
You can look at it every month, monitor it every month. And again, it goes back to the no surprises rule. You know what you're looking at. Yeah. Another way to look at cash needed, a little more mathematical, I guess, is what's your cash flow cycle, right? Just a simple formula, calculating your average daily revenue, and then your usage, your AR days, accounts receivable days, less your accounts payable days. And that'll also give you a good indication of your cash flow cycle as far as what you need. And if you look at an example like we're using here, $12 million company, dividing that by 365 days comes out to very close, $32,000 a day in revenue, and comes out to about $1 million. So that it kind of ties out the same concept, just a different way of looking at it. The 10% of the prior years, or 1.2 million, and it comes out to a very similar number.
Yeah. And I would guess you would probably say if the circumstance of your business vary to where that number is a lot different, then you can go with that by saying, oh, it's because of your AR days is a really long number, or something like that, to say, no, it's telling us a different number. So this is a good side check to say, yep, I'm still in the right ballpark.
Yeah, for sure. Yeah, you need to look at your actual operation. I mean, again, some clients, their customers pay them in 90 days, so that number is going to bump up.
Yeah.
So then taxes, no one likes to pay taxes. No one likes to plan for taxes. No one wants to be caught off guard at the end of the year. That's the worst feeling. So planning for that, being prepared for that is critical. In the transportation industry, as you know, Tom, you've dealt with some transportation clients as well. There's very capital intensive, if you're running assets. So companies can have some timing issues where they buy a bunch of equipment. They may not have any tax in a year because they bought so much equipment. And for tax purposes, they can take advantage of some of the depreciation rules, accelerated depreciation. They may wipe out their tax liability. Well, guess what? It's coming back the next year, right? We've experienced that. So it's critical to still put the tax reserve away, even though for income tax purposes, you may not have had to pay it in the current year. You're still setting it aside so that the next year, when it does come due, you're prepared for it. You've got the money set aside. So it's critical to put your tax reserve aside based on what profit you're actually earning off of your accounting.
Yeah. Yeah. It makes a lot of sense. And the
And
40%.
we use a 40% is a conservative number.
Right.
It may be a little high, and meeting with a tax accountant may say we can drop that down to 35% or 30% or whatever, but
Sure.
that's a good starting point in my experience. And you agree?
Oh, definitely. Yeah. And you definitely want to have more than not enough. And so if you get to the end of the year and you're saying, I should have saved 35, I got this amount extra. Okay, wonderful. Transfer it back. And now you're really happy.
For sure. And just kind of the tax cycle, just this little example, just showing, if you're, first quarter, you made $150,000 profit, putting 40% of that aside, $60,000. Your accountant may have set you up, your coupon may be $50,000 that you're required to pay. So you're paying those every quarter. At the end of the year, you're going to owe total $240,000 you've set aside in your reserve. You've actually paid, in this example, a couple $100,000, $50,000 a month. So you've got a $40,000 balance. And the key is you've got the money there, right?
Yep.
When it comes time, March 15th, April 15th, whenever your returns file, the money is sitting there ready to pay the difference. Right. And you're not going to cause a strain on your operation.
Yeah, that's a great description. And the conversation with the client when you're saying in September 15th, we're going to pay $50,000. And by the way, you have 80,000 in the account is totally different than them being surprised. And Dan, I just met with a client this morning, and we're able to kind of make fun of him now, because what would happen is through the year, you would say, it's looking like your year-end tax bill is going to be $300,000. You're having a good year. Here's that all year. Get to April 15th and say, okay, the check you're going to have to write is $280,000. And he would absolutely freak out because he wasn't setting aside a tax reserve. And I would get frustrated. And I would say, this is the amount I've told you all year. Just last year, he set up a tax reserve. Right. And the conversation was very different, because it was, okay, you've put $350,000 away. Let's write this check. And he still didn't like writing the check, but he had set the money aside. He knew it was there. And so it's a totally different conversation.
Yeah. Having those conversations monthly is critical. And, back in my public accounting days, I can remember presenting people's tax returns and the shock they would get at the end of the year, because they weren't having those monthly conversations. They at best may have had one or two conversations with their accountant throughout the year. And again, they don't stop to think. So yeah, it's good that we review that constantly. So there shouldn't be any surprises.
Yes.
Again, back, you got your operating account, for paying bills, your cash reserve for the rainy day fund, basically, your tax reserve, and then if you need it, getting a line of credit set up. I had a client, Tom, that I took on, or a new client, new business operation, is going to have inventory actually, and a pretty big operation, and they were going to try it. It's like, we think we can do this without a line of credit. And I kept just shaking my, a lot of inventory as well. And I started the conversation with them early, and they kept telling me, it got uncomfortable almost, that they didn't want to pursue one. And I'd already started conversations with a bank, and that I knew, without providing any information, but I had a conversation going that I may have a client that's going to be in a good position. And lo and behold, about a month before they needed it, they say, let's go get a line of credit. So we ended up getting a very large line of credit, which they desperately needed. And then we doubled it like 3 months later, because their business had grown so much. Mm-hmm. And had we not taken the initiative and worked on that ahead of time for them, they really would have been in a pickle, and their business is just flourishing. They're not worrying about cash, but getting that thing lined up early was pivotal.
I agree. And we'll have owners say, if I have that cash reserve, do I still need a line of credit? And we're saying yes. And if you like that, you have about 2 months worth of operating expenses covered. Well, if you get a line of credit the same size, then you've just doubled that amount. And if you think of it like insurance, the cost of a line of credit, if you're not using it, is not very expensive. You're probably in the few $100s a year to make that available. So that's our suggestion.
Yeah, I think that client cost them $1,000 for a huge line of credit. So it's very nominal. Yeah, very painless too. One of the things we really push, obviously, is accelerating your cash flow. It's critical of cash is to monitoring your day sales outstanding. And in transportation, the day from the delivery of a shipment to the day the money's in the bank. So it's critical to monitor that, get invoicing out the door quickly, to turn that cash as quickly as possible. I've seen a lot of circumstances where shipments get delivered, and it could be a week, 2 weeks before they collect paperwork and even get an invoice. So it's really important in my experience, and I'm sure you would echo this, to in any business, from the day that you can bill something, to monitor how long from the day the service is rendered to the day the money's actually in the bank. How quickly are you turning your cash?
Yep.
And a quick example looking at that is if you have a client doing $1 million a month and they're turning their cash in 60 days, they're going to have a big receivable at the end of 60 days and no cash. If they can turn it in 45 days, they're going to have a little bit of cash and still a big receivable. And if you can get all the way down to a 15-day turn, which you can, and some clients, you can really turn your cash flow around just by managing how quickly your customers pay and how quickly you get invoicing stuff out the door.
Yeah, I think most of our clients are shocked when they see the impact of this. And I think often think that there's not a lot you can do around collections. I'll send out notes when it's late. And then you have clients who know that cash is important, and their customers know that the day it's late, they're on the phone calling them and stuff. And so they get paid on time, and it makes a huge difference in their business.
Exactly. It's important to have really build a best practice around the collection process, in my opinion. And again, best time to ask for cash is when you don't need it. It's the best time to go to a bank, get lines of credit set up, even credit cards. There's all kinds of sources of cash. You can additional capital contribution, outside investors if needed, lines of credit, factoring if you're in that pinch. It's not the greatest, but sometimes there are some decent factoring deals out there available. Getting credit card, fuel card programs set up. It always is a good opportunity to ask to use other people's money, and just constantly asking for extensions of credit, even with vendors and so forth, to look for those opportunities to put cash in your control. So it's just better management of your cash flow. Back to the line of credit, just a quick example. Yeah, if you have account receivable balance of a couple $1 million, 80% of that can free up a potential line of about $1.6 million. That's a big amount of money, and hopefully you don't need it. I don't like to see people getting drawn, especially over 50% of that number. I get concerned. That gets really high. But still, having that in your back pocket, I've got clients that have it. If they need it, they may draw on it very briefly. You never know when some equipment could pop up real quick and a really good deal. In transportation, sometimes some trailers pop up and you're like, I got to grab these. And having a line of credit can be a really quick opportunity to get some equipment.
Yeah.
Some of the challenges of poor cash management that companies experience, especially in transportation, drivers, owner operators, if they get wind that you're slow paying, anything like that, they just talk like crazy. Vendors can get, cantankerous. Customers can get wind of it. Employees can get wind of it. Carriers can get scary. So challenges of not paying timely and your days to pay going slow can really impact the performance of your operation. So again, going back to lining up as much as you can, staying on top of that, and managing your cash as best as you can.
Yeah.
Next metric, Tom, financials. That's why we went to school, right? Learn how to do accounting. Right. I didn't even know what accounting was when I was 18 years old and started accounting. I knew I wanted to get a job working during the day and make a little bit of money. That's all I knew. But
business school, alphabetical. Hey, this looks good. I'll take that class, right?
I think I followed a friend. He said he was going to study accounting. And well, that sounds good.
That's
so
fun.
Yeah, financials is the next metric, and having good financials every month and timely, so you can look back historically and see how you're doing, is critical, right? And I know you've run into clients. I have and they'll say, well, we haven't had a clean financial for 6 months. And it's just scary to me. How do you know how you're doing? How do you manage your operation? And again, I'm sure, do you have stories of clients you've had to run into that with?
Oh yeah. And in addition to what you said, Dan, the clients who said, I think my books are pretty good. And as we take a look, a very common thing is that people are not separating their production costs from their administrative costs. So that's
Okay.
a common thing where you're saying, well, I can't
Right.
tell what your gross margin is on the work that you're doing. And you're not putting things in the categories that help you do management reporting. So even the ones that often say, I think my books are pretty clean, are not, they don't have in the format that lets them help run their business. And that's a big
Right.
part of what we do, is try to say, okay, let's start measuring things in a way that you can control and really understand what you're doing.
Right. I was consulting with someone not long ago, and they had to book about $100,000 of expense that, should have been booked already.
Oh, okay.
And yeah, just in transportation, you've got a lot of reserves, you've got a lot of claims, you've got a lot of things that you just not, they don't happen automatically. So preparing for those things, booking them as they come in is critical to get a good, clean financial statement, and being able to know, or how are you doing.
Right.
So transportation logistics, it's obviously very high volume, low margin, and typically 3 to 10% net income as a percentage of revenue is where most companies land. That 10% is getting up there. You look at a Landstar, Renway, someone like that, they are pretty much every year that 6%, 6 to 7% model. They've got a very static model. I've always kind of watched them. You get above that, you're doing really well. You get much below 3%, you're struggling a little bit. So that 3 to 10% is a good number to shoot for. Some companies can hit in the teens, if they're really well managed, really clean, everything's tight. They can hit in that 12, 15, even 17% I've seen on some of the top companies.
Yeah, and you're also speaking to the power of benchmark information. If you were to go to an
Exactly.
owner who maybe they say my usual is 3% and no one can do better than that, what you
Right.
might be able to show them is, no, there are these companies that are doing 10% that
Exactly.
fundamentally look like you. Let's look at what they're doing. And that there's just a lot of power in helping people look. And once they realize someone is making 3 times as much money at the bottom line, then they probably start looking at their business a little bit differently.
Absolutely. And what can they do to trigger that? And that's kind of what we're talking about here. What can we do to drive those numbers up from a 2% to a 6 or 7 or 8%?
Yeah.
Common, I'm really, and I'm sure you are, Tom, it's very critical for a business owner to have his financial statement configured right, just like you alluded to a minute ago.
Mm-hmm.
Having things, I think in my experience, a lot of companies, they start off, they create a chart of accounts, they start throwing expenses in there, and they're just
Yep.
not capturing the data. So in transportation, it's really critical to capture your purchase transportation, which is analogous to cost of goods sold.
Mm-hmm.
What is your purchase transportation? And just this is an example. Typically you're between 80 to 85% purchase transportation costs. That number can fluctuate depending on specialization, depending on a lot of different things, but that's a good starting point. We've got 83% built into our
Mm-hmm.
model. And then you break down your operations expense, which is kind of like sales and marketing. That's
Mm-hmm.
your dispatch, your people who are actually moving the freight, booking the freight, covering the freight. And that number should be in that 7, maybe 8%. And you get down to your admin costs, should be in the area of 4%, getting you down to about a 6% income from operations.
Mm-hmm.
And you may have some other interest expense, other income expense, and just working down to, and we just show a model of making 5%. So obviously you can get companies, and especially smaller companies that were, in the 12 to $50 million, you can have some overlap between operations and admin, people doing
Uh-huh.
different things and stuff. That's common, right? So as long as these two numbers are totally close to it, then you're in good shape. But if you got someone that, well, they work in operations but also help in admin, that's very common. You don't have to worry too significantly about making sure those things are broken down. But if you get outside these numbers, your bottom line, you just don't have a lot to play with.
Yeah, that's a great point. And as I made the point before of convincing that owner they could be more profitable, you've got these additional pieces where you're saying, well, here's what I'm seeing. And maybe it is that their gross profit is not nearly as high. So let's really
Right.
attack that and say, it looks like your operations and admin are in line. So let's go
Hmm.
after this. And so you've got those additional
Exactly.
factors you have.
Yeah, and this is where most companies go wrong because there's so many literally in trucking moving parts. You got fuel, you got driver wages, you got repairs. There's so much in this.
Right.
This is where a lot of transportation companies, struggle to manage that. So it's critical to monitor it every month. What's going on.
Mm-hmm.
This is what your financials should not look like, right?
Okay. Well, if you really like drama in your life, this might
Well,
be just
yeah.
what you need, the roller coaster
This
world.
is going back to my friend. This is what he was seeing when, back when I got into working with him. It's
Yes.
like, oh, we had a great month last month. No, we lost money this month. And it wasn't that he was doing anything wrong. It was just simply they just weren't, doing accrual based accounting, which is what we
Uh-huh.
do, right? Making sure you got a good, clean financial each month so that you can monitor performance and look for, variances, fluctuations in performance.
Yeah.
So what should your financials be? Accrual basis, right?
Mm-hmm.
You got to match up. Accrual means what? Matching your revenue and expenses, right? It's that
Right.
simple. You not when you pay things out, when you actually earn the revenue against when you incur the expense. They should be consistent. In transportation, one of the big things we got to watch for a lot of prepaid expenses, insurance. You've got reserve for claims, like I was alluding to a while ago. The one company I was working with, they had a couple reserve claims from 2 years ago, and they finally got the bill from their insurance company and had to book those.
Mm.
Um, Workers' compensation, booking that properly. A lot of
Yep.
companies will just book based on when they pay it. Well, their wages go up, so their bill's going to be bigger at the end of the year. Reserve for bad debts. It's critical to go through the aging, and if something's bad, not a good receivable, get it off the books or at least account for it. Your financials reliable. You need to make sure they're accurate. Conservative is a big one, right? It's one of the primary fundamentals of accounting. We
Mm-hmm.
don't want them to be overstated. It's always, you go to a bank and your financials are out of line, they're going to know. And eventually it's going to catch up. So being conservative. And then lastly, it's got to be configured for your industry. Whatever industry you're in, it needs to be meaningful, and chart of accounts need to be meaningful so that you can track your progress.
Yeah, those are great. Great overview for these.
In the transportation world, again, back to expense groupings, the purchase transportation, what I typically like to see, and this isn't the Bible, but it's a really good guideline, I think, is your fuel, tractor, anything to move the truck should be in that around 70%. And that's pretty common if you're having an owner operator. You're usually paying the owner operator 68 to 70%. So that
Mm-hmm.
number, whether it's a company driver or an owner operator, whatever it costs to run the tractor should be in that 70% range,
Mm-hmm.
give or take a few percentage. Your trailer costs should be in that 7% range. Again, these are good indicators. They can be, could be 8%, could be 6%. Insurance and claims. This is liability insurance, liability, cargo insurance. Anything your cost to move the freight, and then you always have some other expense, escort, stuff like that. That are in that purchase transportation.
Mm-hmm.
And again, getting back to our example of 83%. And some of the things, in that, you got your DEF fuel tax, depreciation, lease payments, repairs, maintenance, tire expense, plates, taxes, all of that needs to be captured in the purchase transportation costs. What I commonly see, and you've probably seen it as well, is, and you alluded to it, is some of this cost gets put below the line.
Right.
And then it looks like your purchase transportation cost is lower than it is because you haven't captured, for example, I've seen a lot, and you probably have as well, Tom, people just lump insurance together as one line item on their
Yep.
financials. And it's critical to break it out between these buckets so that you really can identify where you're off.
Yeah. And the real risk in doing that is if you believe the number that you have and it's missing some of the cost, if prices start to really get
Yeah,
squeezed, you're
exactly.
probably accepting work that is at a loss because you don't realize it costs you more than what you think
100%.
it does.
100%. And the trailer costs, again, that's your depreciation, repairs, tires, plates, anything to maintain that trailer. Liability, your insurance is your liability, cargo insurance, claims. It's critical to book, in my opinion, in transportation, something for claims every month. You got to reserve for that because they're coming. And you may have 6 months and just have a perfect opportunity and no claims came in. And then all of a sudden you get with a $40,000 claim that's not covered by insurance and you got to hit it all in 1 month. So I think it's critical based on history to book something every month for that stuff.
Mm-hmm. Yeah. Today we've got about 10 minutes left, just to time check.
And again, back to operations, admin should be total about 11%.
Mm-hmm.
And then getting into a forecast. I know you like to forecast. We've got some really cool tools that we use. You talk to a lot of business owners like, they call it a budget, right? That's what we usually tell them. I've got a budget around here somewhere. But we recommend building a forecast off of various drivers. So here's just a quick base forecast, I threw together. And we look at levers, right? So we like to talk about what levers drive your forecast. And building a forecast, if you've got $20,000 of revenue per tractor per month, starting with 45 tractors, adding 5 tractors a quarter, and then what's your P&L look like based on that? And we know there's a lot of other moving parts here, but this is just the base of building that forecast. And then you say, all right, well, what happens if I drive my revenue per truck up $2,000 a month? What's that look like? And you can see the difference in net profit just based on a 10% increase in revenue per tractor per month. And then lastly, ran one of, okay, what if we are able to add 5 trucks a month and keep our operations and admin costs static? We use technology, we use better people, processes. What's that do to our bottom line? And it shows a huge increase in the bottom line based on keeping your operation expense static and driving up your revenue per truck by a couple $1,000 per month. So a huge change in net income, increased net income by $389,000 just by improving expense management and a small improvement in revenue per truck.
Yeah, and that kind of solution you're saying doesn't appear to expose much risk, as opposed to saying, what if I added 10 more trucks? So you got additional interest cost, and if those trucks aren't busy, now you've got a problem. So I like that kind of thinking.
And then our next metric is production. And one we focus on here, if you're running specifically in trucking, if you're running an example, logistics wing, and in logistics, as we know, it's a lot about hiring bodies, putting bodies in seats and trying to get on the phone and book freight. So the levers you can control when you're looking at that model for a logistics operation, how many successful hires you make out of 10, how long does it take to evaluate the other ones? Are you waiting a year to get rid of ones that aren't working out? Looking at your average tenure, people, how long they stay after they are successful. And then obviously compensation and average production out of them, average gross profit. But just looking at some scenarios with that, if we, for example, in our first scenario, you hired 10 people, only 3 of them worked out. And it took 6 months to evaluate the other people and say, all right, they're not working. And you're only doing $15,000 gross profit with the 3 that stuck around. This accounts for some training costs on top of that, a trainer. And it shows first year, you don't do real well. You added about $19,000 to your gross profit. Year 2, you got rid of your dead weight, so to speak. You increase your profit up to $276,000 because your 3 people are starting to turn a profit for you. And then showing, all right, what's that look like if we get 5 out of 10 to work out? And we drive the gross profit to $20,000 per person. Better training, better people, better processes. you could drive up in your year two, increase your profit as high as $700,000 just by driving some of these levers and trying to figure out what exactly you can do to move these things up, move the sticks.
What I really like about this analysis is when you show that dollar amount, it could be $500,000 to $700,000. Then saying, would you be willing to invest to an owner
Right.
50,000 to make the hiring
Right.
process better? And maybe in the outset, they're saying, there's no way I'm paying 50,000 for additional
Right.
testing or something up front. And maybe you say, if you believe me, you can make 700,000. All of a sudden, 50,000 is a pretty quick return.
Exactly. 100%. And then even flipping it one more step,
Mm-hmm.
you reduce your period to evaluate down to 4 months and you get 6 of them to perform. What's that do? So again, 100%, if you can get the owner to look at this small investment, what it can turn into, and this is just 1 year, this is just a 2-year analysis, I'm sorry. It doesn't look out the next 5-10 years. So again, what levers you can pull to drive, this production.
Mm-hmm.
This is a real quick summary, just showing the different, from going from 3 hires to 6 hires, reducing your evaluation period and increasing gross profit, the difference in increased profit just by pulling those levers and managing those. And it all comes down to, better people, better processes, better technology, just managing that, looking for opportunities to improve each of those. And last metric is just real quickly, pipeline.
Mm-hmm.
And it's just all of our businesses, we always got to be watching what's coming in the door. What do we got around the corner, right? And in the transportation industry is no different. First of all, look at the numbers. Look at what was your year-over-year change. Are you growing or not? Look at actual data, right? I think it's critical, and we encourage our clients to always be looking backwards, looking at the trend, and what are we doing this year versus last year? What's the difference? And then even looking at month-over-month changes. What's going on? Why are we seeing fluctuations, increases, mm-hmm. decreases? What's going on? And measuring and monitoring what's driving it. Are we losing customers? Is it effort? What is it? Is it pricing? And some of the key KPIs, there's a number of them you can measure, and the importance is measure it, right? I'm sure you have a lot of customers that they talk and it's common in business, we're killing it, it's doing great,
yes,
and so forth. And you've heard it all, but it's really critical to actually have measurements in place. And you don't have to have all of these, but have 2 or 3 things, I think, that are critical to be monitoring. I don't know if in your experience, Tom, if there's anything that you've seen that your customers monitor specifically, just to watch their pipeline.
Yeah, it's a great question. And to the point that you made earlier, customers measure some things differently. If you ask the salesperson, they're going to tell you about the measurement that makes them look the best. It's completely natural. And so I've had some that, one that I thought was a little bit funny, that he was very proud of how clean their data was and how many new potential prospects he was adding to the database. And it was like in the hundreds per month. Right. But the closes of new business was nearly zero. And so it's just funny to get off, and he was very proud of the work he was doing, but I had to step back and say, but as a sales guy, your main job is not clean data and just adding people to a database. It's closing work for that. And so I think where you're saying, no, these are the ones that we're going to agree we're going to measure that really drive business forward.
Exactly. We were real big on how many RFPs we completed and our improvement, and then what did we get off of that business? Not just going through the motions, completing them. Sure. Were we actually seeing additional business out of those accounts? And it's not immediate all the time. And really monitoring CRM activity. What are people actually doing? I think it's really critical.
Yep.
And then in transportation, each one of our, as you might imagine, every industry has a lot of KPIs, or I like to say vital signs. Each one of them, cash, watching your days to pay and everything, financial, your gross profit per day, per week, back to production, revenue per truck, working day, all of those. It's just critical to pick. You don't have to monitor all of these, right? I'm sure we see some of our clients get an analysis paralysis, but pick something that's meaningful, that you can drive, and you can make a difference in the operation. And I like to see, and I know you've have done this as well, just a real simple
Just a scorecard, right?
grid.
Yeah.
Yeah, just a scorecard. Very easy for anyone to look at if it's a weekly, monthly basis. Just showing, are you up, are you down, are you yellow? Just so you can very quickly spot any issues that are going on with KPIs that you're monitoring.
Yeah. And what I really like about this, and I've got clients that I've done this really well for, and I've got some that I didn't get it set up initially. But when you're doing the annual budget and plan, often you can come up with what were our assumptions we built into this plan. And it's pretty easy for owners and the team to agree on these metrics up front, where you're saying, is this what good looks like, for example? And then when you're measuring and saying, so our gross profit per week per day looks red, and when the person who's accountable for that gets upset, you're in a little bit better position to say, remember, we agreed and our plan is built on this.
Right.
So here's why I'm calling it red. And it's a really nice, simple way to demonstrate that.
Exactly. And I think it's important not to have too many KPIs. Wouldn't you agree?
Oh, yes. Yeah. You got to be able to focus.
Yeah. I think it's important to have good information. I'd rather have 5 KPIs I'm watching and have really accurate, good information than have 20 and they're all garbage.
Yeah, I think you're right.
So back to our metrics, cash, watching your cash, watching your financials, not only your income statement, your balance sheet, keep an eye on it, your production metrics and whatever is driving your operation, pick the ones that are going to drive it the most, and monitoring your pipeline, what's actually coming in the door. And then identifying those levers that make those metrics move, right? What moves your using a football analogy, what moves the ball down the field, what is it that's going to put the ball into the end zone? So whether it's improving your days of pay, your impact of hiring producers, or small changes in net income just by managing the expense and getting more efficient.
And Dan, this, I think both demonstrating the value of having a person who focuses on the individual niche. And I've gotten that experience from you, as you and I have talked about a couple of my clients that are in this industry, and your knowledge is really good. And as accountants, we see lots of businesses, and many of them, there's some similarities, but there are differences, and they run
for sure
differently. The other thing I really like that you described is we'll often talk about, as a VCFO, we'll meet with our clients 4 to 6 times a month. Absolutely. And a common reaction from our accounting peers is, what could you possibly talk to them 4 to 6 times a month? If I may be a tax guy, I might meet with a client once or twice a year. There's no way there's something. You touch on so many things that you can see the different meetings around things like a forecast focus meeting and a pipeline forecast meeting, financial statement. There's all these different things you can be drilling into those 100%. Where you're really partnering with that business owner.
Yeah, we're trying to drive the business forward, right? We're using historical data, and then we're looking forward with the client, like, how can you get better now? How can you take that historical information, which is critical, and then taking that, but absolutely the importance of the cadence to establish those meetings with clients and keep on top of the stuff is I can't stress it enough.
Yeah, and you start a story with a client who's using his wife as a bookkeeper, which I think is a pretty common small business approach of, I've got a bookkeeper who may do this on a part-time basis and they don't have a lot of experience. But when I was starting out, that was the cheap option.
Sure.
I can imagine the power if they end up hiring a person who their expertise is in this niche to come in and say, hey, have you thought about this? And if they haven't had the metrics, you're coming in and saying, well, here's what I'd recommend. And you showed us about 20 different things you could measure with benchmarks. And I can only imagine someone saying, wow, I want to go with the person who knows the niche, they know the industry, they've been in this, they know how to do it, versus someone who's smart and let's build the whole thing together. Maybe that works, but it sure takes a whole lot longer to do that.
Yeah, I think just having an understanding in any industry, whether it's construction or manufacturing or whatever, having a handle on the industry and understanding it, understanding the challenges that face the business owners is critical, and it just brings additional credibility to the advice you're giving. Yeah.
So someone who works in transportation, I would hope the listener is looking and saying, here's some great advice I have around that. I think this discussion is still valuable for someone who's not in transportation logistics, because they can say, okay, do I have a niche? Could I describe my niche in the same kind of way that Dan did? And you had some really good benchmark information. do I have access to that kind of information to say, okay, so for my industry, it's really a 15% margin, and here's how much you should be
Right,
spending
for
on
sure.
admin and things. So I would hope it would motivate someone to say, here's a structure they could use, even if they say, okay, I'm not going to be the transportation and logistics person.
Absolutely. I think the core principles apply across the board, to every industry. So, but same concepts: monitoring cash, financials, production, and your pipeline.
Yeah. This has been excellent. Thank you very much.
Thanks,
I'll
Tom.
leave with my
Enjoyed it.
final disagreement. You start off saying I'm not the expert, and then over and
Um,
over showed that that was not the case today. So I appreciate
I
that.
guess that means I'm old, Tom.
I'll let you decide if that's what you want to say. Well, this is great. Dan, thank you very much. I really appreciate the conversation today.
All right. Thank you, Tom.